Corporate directors, so we're talking the board of directors. What do they have an obligation to do? What are their rights? Let's talk about them specifically. We talked about the shareholders. Moving on to the directors. Well, the directors' duties, they have specific responsibilities, including electing, removing, and supervising officers, adopting, amending, and repealing bylaws, determining management compensation, and initiating fundamental changes to the corporation structure. And they kind of oversee the 10, 20-year plan. Distributions to shareholders, as we talked about, that is up to the board of directors. They have the sole authority to declare distributions, also known as dividends. Shareholders cannot force a distribution. I mean, maybe they can write a bunch of letters, but they can't force the board of directors to give them dividends. Directors who authorize an unlawful distribution may be held personally liable, but they can defend themselves under the right to rely on the advice of others. If you've got a board of directors who they didn't do it correctly, then yeah, that's what we're talking about here. Maybe they gave too much of a dividend, but not really going into too much detail there. Directors can also recover from shareholders who knowingly received unlawful contributions. Now, for directors' liability in the business judgment rule, directors are fiduciaries, and this is not specific to corporations. This term fiduciary happens in all throughout accounting, right? It means that they must act in the best interests of the corporation. Just like an agent, you work for your employer. You have a fiduciary duty to your employer to act in the best interest of your employer because they're paying you. However, they're not responsible for guaranteeing the corporation's success. That would be a little ridiculous, guaranteeing that the corporation is going to be the number one corporation in the world. There can only be one. Under the business judgment rule, directors are not liable for acts or decisions that were made in good faith. So if they didn't do any due diligence and they just threw all their money into some stupid investment and lost the company money and it went under, that would not be in good faith. But if they hired an investment firm to kind of help them make some decisions and they can prove in a court, even if their investment went totally wrong, if they can prove that, yes, we acted in good faith, we acted in the corporation's best interests, we exercised the care of an ordinarily prudent person, then we are good to go, right? If Nike all of a sudden says, we want to get into cryptocurrency, right? And they do zero research, they just dump all their money into that. Yeah, that would probably not be in good faith. However, if they want to get into some sort of technology, they hire a bunch of consultants to help them, and they actually can prove that this had a meaningful impact and could have significantly helped the company, then that would be in good faith. Directors are only liable for negligent acts or omissions, such as failing to obtain insurance or hiring an employee without proper background checks. The normal flow of business governance is that, now this is just restating kind of what I mentioned before, but shareholders elect the board of directors. The board of directors hires the officers to manage the company's operations, and all these people are working on behalf of the shareholders. Even if they forget it, sometimes you get management who they get a little high on their horses and they start making decisions for their own bonuses and compensation and all that. All right, more corporate director duties. Now, in a C corporation, again, directors and officers, they do owe a fiduciary duty to the shareholders. Now, this includes due diligence. They're required to act with care and perform their responsibilities with diligence. They must make informed decisions based on the information available, thoroughly analyze potential risks and opportunities, and seek expert advice when necessary. Just like you as the auditor have a fiduciary duty to those who are going to read the financial statements, just like you as a tax professional have a fiduciary duty to your client. The right to rely. Directors and officers have the right to rely on information, reports, and advice from experts such as legal counsel, accountants, or other professionals, as long as they reasonably believe that these experts are competent in their respective fields. The duty of loyalty. Directors and officers must act in the best interest of the corporation and its shareholders, putting the corporation's interests above their personal interests. A lot of this kind of goes hand in hand with each other. And it's not like you have to memorize these exact things. You just have to know that these exist. It's not like we're going to ask you which of the four is a duty of a corporate director, right? So you just want to know that these do exist and understand them if they were brought up on the exam. And also, you kind of get the idea. You get the gist of what's going on here. You got to act in the best interest. You have to make positive decisions, right, on behalf of the company. Decisions that will, in a perfect world, help the company overall and thus help the shareholders. So reasonable belief, all those good terms, right? Reasonable assurance, talking about auditing. We don't want to put ourselves on the chopping block too hard. Act in the best interest of the corporation shareholders, putting the corporation's interests above their personal interests. Avoid conflicts of interest, self-dealing, and ensure that corporate opportunities are used for the benefit of the corporation rather than a personal gain. So if you are a CEO of a company and maybe you have a side business going on and you see the opportunity to buy some inventory at a really cheap rate, well, if that inventory can be used by the company and your side business, because you work for the company, it is in your best interest, or not your best interest, but it is your duty of loyalty to use that business opportunity for the company rather than for your side business. And lastly, indemnification. In certain cases, a corporation may indemnify, for example, reimburse its directors and officers for expenses and liabilities incurred as a result of legal actions brought against them for actions taken in their capacity as directors or officers. This is intended to encourage qualified individuals to serve as directors and officers without fear of personal financial loss due to potential legal claims. However, indemnification is typically not available in cases of gross negligence, intentional misconduct, and a breach of the duty of loyalty. So if let's say a CEO makes some decision and again pollutes the river, you never want to do that. Do not pollute the river, save the environment. And a bunch of individuals sue that CEO, and they don't sue the company, they sue the CEO. And let's say that the CEO just acted in good faith. I know somehow they acted in good faith and they still polluted the river. Then that's what we're talking about here, that the company will reimburse them. However, if the CEO just didn't care, said, oh yeah, dump all the trash in the river, they said, yeah, definitely, throw it in the river, they breached the duty of loyalty. In that case, they would be on the hook for themselves. They are not getting the defense of the company. We talked a lot about directors, officers. We're going to hone in on specifically your officers, right? Your C-suite, your CEO, CFO. The officers of a corporation, they play a crucial role in managing the day-to-day operations of the business. We have some key aspects to understand. First off, the roles and responsibilities. Now, officers are individual agents and employees of the corporation responsible for conducting day-to-day operations. They have the authority to bind the corporation to contracts made on its behalf. Probably not something as significant as a merger or acquisition, but more so contracts such as buying supplies from a particular vendor, something like that. It's worth noting that a person can hold more than one office within the corporation. But yeah, you can have someone who's the CFO and the CEO. Depends. I mean, there's no rule to break that out. So does it make sense to do that? It may in some cases. Selection and removal. Officers are chosen by the board of directors and can be removed by them with or without cause. They are not elected by the shareholders. Authority and power. Officers, as corporate agents, have the authority and power determined by agency rules. Beautiful lesson we got coming for you down the line there. A corporate president, for example, typically has apparent authority to enter into contracts and act on behalf of the corporation in the ordinary course of business. Now, like corporate directors, officers are subject to fiduciary duties as well. They must act in good faith and with the same care as an ordinarily prudent person in a similar position. So that's just in a court. If the average person would make a decision kind of in that position, that's kind of the basis that we use for that. Officers can be indemnified for expenses and judgments from litigation brought against them in their corporate capacity and are protected by the business judgment rule. Now we got fiduciary duties as well as dual roles. So it's possible for officers to serve as directors of the corporation as well. Had you become a member of the board of directors, don't worry about it. We're not going to worry about that too much at all. And then lastly, as I kind of previously mentioned, although not required, officers can be shareholders. It's actually encouraged that they're shareholders. They're not obligated to hold shares in the company, but may choose to do so. If someone wants to just be a career CEO and just run a company, awesome, great. And maybe they do a great job. Maybe they do a poor job. Maybe they just do a run-of-the-middle job. But if that individual does own shares in the company, they're an owner. And as such, they would probably do the best job possible to make the share price go up, to make sure that the company's profitable and doing whatever is in its best interest for it to make money. This would align the interests of the officer more with the shareholders. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.